NASDAQ outperforming today. All the major averages near session highs, but all three major averages are on track for weekly losses. Mike, it's kind of a weird day. You've got energy continuing to move higher. Technology looks strong. The chips are having a little comeback. Obviously, banks are down on earnings. What is the narrative today and for the week, which is ending with some declines, but nothing as major as it's felt for some of these individual stocks?
Yeah, I mean, I think you're seeing a little bit less of a perfectly clean kind of migration from, the growth into value as we've seen before. A little bit of a bounce here. You have yields near their highs. Market largely digested the absolute, loud drumbeat of all the Fed speak. And, we're 3% off the highs in the S&P with a ton more kind of damage handed out below the surface. Now we're in a Fed blackout period and, probably going to be more about earnings going ahead, which often just is kind of, offsetting moves, based on corporate fundamentals as opposed to the big macro picture.
Charlie, you've said for so long that you're expecting inflation, 7%. It's not really that high, though, is it?
I hope you're kidding. It was projected to be 2% at the beginning of the year. Maybe I was considered a wild inflationista by saying it might be 3.5%, and it came in double what I thought. So inflation, obviously, much worse than anybody could have expected. Obviously, disappointing that the Fed was so behind the curve, and now they are finally seeing what the rest of us have seen for a while, which wasn't that hard to see, which is that we've got really persistent inflation. And now we're starting to get the problem of inflation expectations. We're going to have workers who are going to be asking for raises. We have pricing that Netflix is taking price increases because of inflation. This can start to spiral, and it is too bad that the Fed was so long in coming to the party.
So do you think it was like we're going to have a major hard landing because of it now, or can they still rein things back in?
No, I actually think the economy is so strong and there is so much pent-up demand that I think we're going to be able to get through this. I think the consumer is in great shape. Balance sheets are in great shape. There are so many people that want to buy cars and houses and services and go on vacations. And I think we're at the worst point in Omicron. I think the news from here is going to be better. And that's going to help a lot. And so for all those reasons, I think we're going to be able to get through this. But bondholders are going to get hurt because we are going to have rising interest rates on the back of all this inflation.
Wells Fargo performing the best of the major banks today, reporting results this morning. It's up 3%, while Citigroup and JP Morgan trade in the red. Earlier this hour, we spoke to CFO Mike Santomassimo. I asked him whether he was concerned that Wells Fargo could fall behind if it doesn't ramp up investments in the same way that JP Morgan is.
We start from a different place right now, and I think we continue to have a lot of efficiency opportunities across the place that not only save us money, but give us opportunities to make the experience better for customers. And we are investing in our businesses, whether it's in technology, people, we're adding investment bankers, commercial bankers, we're adding technologists across the board. So we are making the investments we think we need to make to continue to stay competitive with our peers.
Up 3.4% for Wells Fargo, while JP Morgan's down 6.3%. What do you think, Charlie, of this sector, and what would be your preference within it? I mean, Jamie Dimon also highlighted earlier today that if they don't hit 17% ROTCE this year, they're still going to hit 15 or 16, which is still well ahead of the rest of the pack.
Yeah, a long time ago, my grandfather, who introduced me to the stock market, taught me to look at price to book when you evaluated banks. And his rule was buy them at 1 and sell them at 2. And JP Morgan got very close to 2 times book here. I think it may have started the day at about 1.9 times book. So it is a great bank. It was not an inexpensive stock. It was probably an expensive stock. And so some of this is, some of that sheen is coming off a little bit today. We've got a lot of other banks that are more reasonably priced that I think are going to hold up fine. The other thing I'd point to is costs. JP Morgan is city-centric, coast-centric, and they're going to have cost pressures on the labor front, on a number of procurement fronts that maybe a bank that we love, like Bank of Oklahoma in Tulsa, is not going to face.
I was just going to ask which ones you like better and think are better priced, because we're actually seeing a pretty big divergence in the financial sector today in terms of performance. Wells is up, as we noted, and a lot of the regionals are doing well, despite the big loss for JP Morgan. So what else do you like?
So we like banks that are going to do well in a higher interest rate environment. Those would be the custody banks. Northern Trust is our favorite, has a wonderful set of relationships with the Forbes 400, but also just does well in a rising interest rate environment. Bank of Oklahoma is the biggest lender to the energy industry. The energy industry has not used a lot of capital. As oil's gone to 80, it's going to start using more capital, so their loan growth is going to be excellent. And it's a cheaper bank, frankly. It's just trading at a much more attractive price. Those would be the two that I would call out, Bank of Oklahoma and Northern Trust.